Hello, everyone. David from Mortgage Choice. It is Wednesday, the 8th of March, and the Reserve Bank yesterday increased interest rates by 0.25%. And when we heard the news yesterday, it wasn't a surprise. We knew based on what the Reserve Bank announced back in February that they were likely going to increase rates again this month, and they did just that. Interestingly, though, in their notes, they did comment that they may be reaching towards the peak of their interest rate rises. So hopefully we're getting closer to the end. They mentioned that inflation peaked back in December, and they've mentioned that a number of factors that they were concerned about are turning out not to be as much of an issue as they first thought. They thought there was some kind of a wage growth spiral that we might see where the price of goods continues to increase along with wage growth. And if those two things increase, then it's really hard to bring inflation under control. So it looks like the wage growth issue isn't so much an issue at all, a bit of a storm in a teacup. Fingers crossed that's the case. Because I think all of us would want to see or hope to see interest rate rises stop for a period of time so that we can all catch our breath and just see how much these increases will actually impact the economy. As we've spoken about in previous videos, it does take 6 to 12 months for these interest rate rises to actually affect the economy. And the other glaring issue that we're facing here is a fixed rate cliff that everyone's been talking about in the media, where half of mortgage holders are coming off fixed rates over the next 6 to 12 months, going from 2% up to a variable rate of 5 to 5.5%. So it's going to be a massive shock for those clients. I'm hoping that those clients or my clients that are on fixed rates have already had discussions with us or are planning on having discussions with us about how they can manage those higher repayments. Because it will come as a bit of a shock to the system when it hits. Rather than going too much further into inflation, because again, there's so many factors that determine how fast inflation comes down and if we're getting ourselves back on track, I'd like to focus more on two main issues that I speak to clients about every day. The first one's the borrowing capacity, and the second one's the property market. So touching on borrowing capacity first, the number one issue that clients are having right now is that their borrowing capacity is a lot less now than it was 12 months ago, back when interest rates were at 2%. So clients have expectations that they can borrow for, or that they can purchase, for example, at 1 million. And then after our discussion and after our review of their borrowing capacity, we come back and say, well, actually, your borrowing capacity will only support a purchase of 750,000, or much less than what they're initially expecting. And this is for first home buyers, this is for investors, and this is also for upgraders. So anyone looking to buy a house, they're finding that their borrowing capacity is a lot less than they expected. So my advice to everyone out there is that if you're thinking of buying a property in the current market, give us a call. Let's review your borrowing capacity. And that will require that you send in pay slips so that we can confirm exactly what the bank will want when we're trying to work out what your capacity is. And we'll be able to tell you with a great deal of assurance where you stand and what you could potentially purchase for, so that you're not going out and getting excited about a property that you ultimately can't buy. The second thing is the property market. A lot of people are concerned about the property market, and there's a bit of doom and gloom in the press about values dropping drastically. I don't really see it that way. I think that the property market will potentially contract 5 to 10%, but we're not going to see the 25 to 30 to 50% falls that a lot of people in the media were predicting, mainly because we're a growing population. Australia is adding 200 to 300 people, 200 to 300,000 people a year through immigration. So I don't see the property market dropping anywhere near to the levels that some people in the media are saying. In saying that, we are starting to see some contraction. And we see that in the valuations that we get from banks, because bank valuers are always more conservative than a real estate agent will be when you're trying to work out the value of your property. So just keep in mind that we have started seeing some pullback in certain pockets or certain areas, certain suburbs. So don't be surprised if your valuation comes back 5 to 10% lower than what you're expecting. As we've spoken about in the past, there are a number of ways that we can try and offset these interest rate rises. The easiest thing to do is to call your existing lender and ask for a pricing discount. And if you haven't done this in the last 3 months, then try and do it now. Banks continue to offer better discounts for new clients, and they leave existing clients on the same interest rates. So you don't end up getting the same discount that you would unless you were a new client. And so there's a disparity then between your current variable rate and what someone new to the bank will get. And that doesn't really seem fair to me, right? It's a backward system where the banks don't really look after their existing clients unless you call and you kick up a fuss. So the recommendation is to give your current bank a call, ask for a pricing discount, tell them that you're going to refinance to a different bank unless they help you out. If that doesn't work and you feel like there's still a discrepancy between your rate and what a new client would get, then give us a call and we will look to potentially refinance you. And when we look at refinancing, there are a number of lenders that are offering $2,000 to $4,000 cash refinance rebates. And that $2,000 to $4,000 can also go to help offset some of these interest rate rises. Every time an interest rate goes up by a quarter point, most people's home loan repayments increase by about $50 per month. So if we can get you $2,000 to $4,000 in cash rebates, that will help offset 1 or 2 or 3 rate rises for the next 12 to 24 months. So definitely consider a refinance if your bank is not being competitive with your rate. The third thing that you can look at doing to help improve your cash flow and help offset these interest rate rises is to consolidate debt. And we're looking mainly at car loans because car loans have a massive monthly repayment. Some car loans can be anywhere between $800 up to $1,500 a month, depending on the purchase of the car. And that's a massive hit to the cash flow. And if we can take that $20,000 to $50,000 car loan debt and spread that on your mortgage over a 30-year period, it's going to give you a smaller required repayment. Now, is it the best thing to do long-term? Absolutely not. We don't want to take a car loan and spread it out over 30 years because it increases the amount of interest that you have to pay. But we're looking at making the best of a bad situation right now where interest rates are quite high, and we want to give you a bit of relief. So the way to do that is to take that debt, spread it out over a 30-year period, give you a smaller required repayment. You can continue to manually make the same repayments or close to the same repayments that you are now to try and continue paying that debt off in a timely manner. But you can also fall back to a smaller required repayment if cash flow is an issue. The last thing to do is obviously, if you're in a bit of strife, then you look to sell your property and clear the debt. And what we don't want clients to do is to put their heads in the sand and pretend like there isn't an issue going on and to delay that, because the longer you delay, it could potentially hurt your credit, which will then affect you purchasing in the future. So if you've got issues, please give us a call. If we can't directly assist by refinancing or consolidating debt or doing any of the things that we can do, then we try and put you onto the bank and get onto a hardship arrangement. And if that doesn't work, then you look to potentially sell. All right, so a few options there. Any questions or any concerns? Obviously, we're always happy to chat. I do Zoom appointments and phone appointments late on a Monday and Tuesday. So I'm working until about 8 or 9 o'clock at night on a Monday and Tuesday, and then office hours throughout the rest of the week. So if you've got any questions or concerns, please let us know. Always happy to chat. Last thing to mention, tonight, Wednesday night, the 8th of March, we are doing a first home buyer webinar. And I think it's a timely discussion for first home buyers because it's so complex in that environment right now. You've got so many different government grants, some good, some really bad. And you've got a number of things to factor in, how much deposit you need, what your borrowing capacity is. A lot of first home buyers are single and purchasing on their own. And that means we need a significant amount of income to even purchase at $400,000 or $500,000 because of the increase in interest rates. So if you or if anyone you know is looking to buy their first home, the registration details will be below. Please click on that and join us tonight. It'll last about 30 to 45 minutes, and we'll take you through everything you need to know as a first home buyer. Thanks again for your time. I'm hoping that next month we've got a bit better news, and hopefully we're seeing the end of these rate rises, and I can bring you good news that we're putting rates on hold. So fingers crossed, and have a great month. Thank you.